everybody, and welcome. Tom Daly here from the Academy of Financial Trading. We are about to begin your 10th lesson as part of your foundation trading program. Where has the time gone, ladies and gentlemen, over the past few weeks where we all worked together to cover off that complete foundation level knowledge of the financial markets? This evening, I hope you will all know at this stage, we will start out with our risk warning. It is important that we all appreciate the risks associated with leverage trading. I'm sure that you could memorize this risk warning at this stage just about as well as we can. It's pretty topical given the fact that the last webinar we really looked at how one could mitigate their risks in the financial markets and really make informed decisions about what exactly we wish to do. Before we get into the thick of this evening's class, just for my own peace of mind, if you wouldn't mind just a quick sound check just to make sure everything is coming through loud and clear. So if you wouldn't mind just typing in even the letter Y or the word yes or something in the affirmative so I can make sure that everybody can hear me loud and clear. Great stuff. Everybody, all the Y's, all the yeses, a very warm welcome to all, and an especially warm welcome to our newest, latest members of the show, Academy of the Academy of Financial Trading. Delighted to have you back on board. So let's build from all of the previous lessons. There are some remaining topics that we feel we must address. Okay? And those remaining topics, they stem from our own real-world experiences. It's important to note that we here at the Academy of Financial Trading, we trade our own capital, we trade corporate funds, and we have done for several years at this stage. And when we speak about trading psychology, this is a topic which most in the educational space would spend many, many hours speaking about, because it's a nice, large, fluffy subject which we could speak about forever. From our perspective, that would probably put us to sleep, and from your perspective, it would be of little use. So what we are going to do is we're going to look at it a little bit differently as usual. What we're going to do is we're going to speak about areas which have created difficulties for us, and that should help you to not allow that to happen to you in your trading career. Then what we will also look at is how we can use those other or the difficulties that other people might have as opportunities for us. And if we get a chance, as I promised you during the last class, we will have a look and see if we can get through the full process of placing a trade as far as we are concerned. Okay? So that will, if time permits, we'll hopefully get through that. We'll also obviously cover that journaling process, which is a way of recording your own performance so that you can see exactly what you are doing. Many people say in financial trading, and indeed many other areas, that one of the key differentiators between those who are successful and those who are unsuccessful tends to be their mindset, how they look at the financial markets, let's say. What we mean is that what we think and what we feel essentially have to become one. So in order for you to follow a trading strategy, you've got to have confidence within it. In order for you to be disciplined, you've got to know that something works. And if you have to question yourself every single time you put in an order or every single time you place a stop loss, well then in those situations you really don't have a trading strategy. So how could you be confident in it? And the answer is simply that you couldn't. So what we find the solution to all of these sort of difficulties are, they will come from you being informed, knowing what to expect, so that you are never going to be surprised and you know how you should or how you could react. And again, it boils down to education, it boils down to preparation, and that's as a way of protecting yourself. And moving on from that, who here could help us to identify what some of the key reasons why new traders have difficulty achieving success? What sort of reasons create difficulties, guys, for new traders? What do you think? What sort of areas do you feel create difficulties for new traders? Lisa, you're saying following the news. Fair enough. Mark, you're saying no risk management. Absolutely. Sumra, the fear of losing money. Absolutely as well. Stephen, the lack of knowledge. What else have we got? No patience, says Manish. Absolutely right. And a lot of people are also saying no trading strategy. And absolutely, that is the first one in our opinion. Okay? When we talk about that, we mean that they don't know when they're going to enter. They don't know when they're going to exit. They don't know how much they're going to trade. And they certainly don't understand that second heading, that risk management approach. And that word risk management, essentially, it's also saying that they are trying to protect their profits. They're trying to protect each time they have a position in the market. And then the third heading, which we're going to speak about this evening, that is of mental preparation. And that really is the glue which will bind the first two together. So let's start looking about some of the truths relating to this heading. If you're trading and if you don't have a strategy, it can be quite dangerous. If you're trading and you don't know how to manage risk, it can be construed as gambling. If you're trading without emotional control, it's even more reckless. But when we're speaking about these types of headings, risk management is one of the most important, but the psychology side of things is also crucially important. How would you feel, guys, if you came home one day and if your account was up, let's say 300% or 400%? How would you feel if your account was up by that amount when you came home over one day? How would you feel? What would you think? Okay, Jim, you're saying great. Paul, you're saying happy, absolutely. What else have you got? Ruskana saying ecstatic. Neil, that's a bit far, okay. Awesome says Gus. Party time, says Ricky. Close the position, says Jayant. Take the money and run, says Marina. What else have we got? Sad, says Miguel. Okay. Fernando's answer, I think I prefer. Fernando has simply typed in one pretty straightforward word, and that is impossible. And the point that Fernando is making, it mightn't veer too far from our own thinking, because you could come back and find your account up by 300 or 400%. But if you were a professional trader, it's highly likely that you would be fired for that sort of a performance in any one day. Can anybody help us out and tell us why? Why might a professional trader be fired for bringing in a 300 or 400% return in one day? Anthony, you have it. Dieter, you have it. Ake, you have it as well. Loads of people getting it. Well done, Gary and Marie. Well, there's way too much risk involved. There's a ridiculous amount of risk involved. And that's what's resulting in that sort of return. Now, if you like living on the edge, if you like risking everything for a small gain, well, then maybe go and do it. But large wins relative to your account, they will stem from large risk. And then we say that jackpots, they are only for casinos. Financial trading, it can be quite monotonous. It can be quite repetitive. And the reasons why we use these sorts of words is that if it's not monotonous, if it's not repetitive, then it essentially means that you are going through a state of shock, which means that you were not prepared. So you never want those heightened emotions when you are trading. Has anybody ever gone through a stage of heightened emotions? Whether it's from losses or gains or anything like that. Has anybody ever gone through that sort of emotional state, that heightened emotional state? Gary, you're saying yes. Robert, you're saying you're going through it now. Okay, what else have we got? Of course, says David. Yeah, it's not something that you would ever want to replicate. Imagine if you were driving down the street. Okay, and imagine if you saw another car coming towards you, and if you were that shocked by the event that you jumped into the back seat of your car and jumped out the window. That would make it pretty difficult to get to work every day. If every single time you saw another car you were just in a state of shock. Well, as a trader, if you're going around in shock, it's very, very dangerous. And that's why you need to make sure that you've got that full trading strategy. Okay? Eric, absolutely. I think you would be involved in that same kind of environment if a bear did charge you. I absolutely think so. So when it comes to a mindset, there are two specific kind of mindsets I think that we can generally have. You can have a subjective mindset or an objective mindset. A subjective mindset means that you are relying upon your own interpretation of the facts in order to make a decision. And there are a category of traders called discretionary traders, and what they will do is, I suppose in the politest of senses, they will make it up as they go along. Okay? So what they will essentially say is, based upon all of these variables and all of these pieces of news, this is my decision, this is my opinion. And that can be very, very dangerous. Because if you're totally new to trading, and if you're making it up as you go along, that's not necessarily the best idea possible, is it? If you're totally new to trading and if you suddenly decide that you're going to make it up as you go along, it's not the best of ideas. And as well as that, one would prefer typically to be objective, to base your trades on a rational basis only, a fully rational basis. And the best way of doing this is through pending orders, setting up your orders in advance, so that if the market comes to your orders, then you are saying that you were right in your analysis. So you're saying if the market comes to you, then it proves that you were right in your analysis. And this allows you to be much more rational and to focus on those longer term movements. Okay? And Keith, we prefer not to use a hybrid strategy, which would be a mixture of both. You can't really be both subjective and objective. You can't be analytical and discretionary. I think you have to be one or the other, to be honest with you. So when it comes to this area of loss aversion, this is one that people have a lot of difficulty with. It's really quite straightforward to understand, because when we speak about loss aversion, what we really mean is that there isn't a single one amongst us who would like to lose. Nobody likes to lose, and ladies and gentlemen, do you think that your strategy, whatever it may be, do you think it will be 100% accurate? Or maybe even better put, do you think that it needs to be 100% accurate? What do we think? Do you think that your strategy needs to be 100% accurate? At this stage, guys, thankfully, everybody is correct. Your strategy does not need to be 100% accurate. In fact, if it is, there's probably something wrong with it. Okay? We need to understand that losses will occur. And as long as you're making a profit, frankly, who cares? Okay? The only people who will care are those who might be insecure, those who might have inappropriate expectations. Because some traders really don't like having a losing trade. Okay? What they will attempt to do is they'll attempt to avoid that losing trade by giving that losing trade more room to actually go against them. And then they might have a marginally profitable trade, so what they might try to do in that instance is realize that full profit much too early. So they will give bad trades more room and they'll give good trades less room. That's a typical trait of a new trader. Okay? Has anybody come across that before? We covered it in the last class, talking about that negative risk reward, where we all agreed that it just did not make sense. But everybody still does it. This is a fundamental principle of the financial markets. New traders are bad traders. They let losses grow too big and they let their winners grow too small. But the really interesting thing is essentially those market makers, those institutional traders, they take the exact opposite approach. Okay? What they do is they let their gains win, or they let their gains grow as far as is physically possible, and they'll cut their winners as soon as is physically possible. So they do the exact opposite. They do what retail traders think they're going to do, except retail traders just don't do it. Okay? So knowledge and knowing what to do is going to be crucially important. We also have that heading of fear. And fear it's how we would react to a threat. We all feel fear at some point, of course, but it's when traders give in to that fear that is when it is at its most dangerous. So what do you think a trader might do when they give in to fear, guys? What do you think? What do you think? What sort of crazy actions might they take when they give in to fear? Dimitri, absolutely, they would certainly panic. Absolutely. What else would you get? Graham, you're saying get out. Keith, you're saying make irrational decisions. Absolutely. Mark, you're saying doubling down. Marie, you're saying to react negatively. Miguel, you're saying to pull out. Tim, you're saying they will risk loss. Tracy, you're saying leave themselves open to risk. Inez, you're saying they will put more money when losing. Absolutely. They behave recklessly. They do all these things. And it's not because they felt fear, it's because they overreacted to it. That can cripple a trader. They must learn to not put themselves in situations where they feel fear. Now, from your own perspective, you're probably considering what path to take after these lessons. And you're probably wondering if you're going to go out and trade, if you're going to learn a trading strategy, or what are you going to do. But regardless of what the path might be, you've got to really know what you are doing. And you've got to manage yourself so that you do not go through these sorts of mistakes. An overreaction to fear might be when you see a turbulent market and you might close all your trades. Every single webinar series which we deliver, participants are on it and they start looking at the financial markets and they always say to us, well, the markets are a little too volatile right now. Has anybody think that? Does anybody believe that the markets right here, right now are too volatile to actually trade? What do we think? Okay, I can see a small number are saying yes, but the issue is that financial markets, they're like a soap opera. Okay, they're like a play, they're like a drama. There's always drama, there's always some political instabilities, there's always some fluctuations, there's always some chaos. That's what makes this, I guess, exciting in a way, because you're always learning, it's always changing. So panicking just because something is changing is a sure sign that you either don't know what you're doing or you are not good at what you're doing. We like change. And some people out there, when they see change in the markets, they start taking huge positions. They try to fight back. Has that ever happened to anyone? You see a losing position and then you start trading with a much larger position to try to win your way back. It's very dangerous. Absolutely. Michael, you'll definitely agree. It can end really badly. You might even take off a stop loss. And if you do that, it doesn't make any sense, because when you put the trade on, you would have given it due attention. You would have decided upon its initial stop loss. So why would you go and take it off after the fact? It's perhaps because you're feeling that rush of adrenaline. But that would not occur if you had been fully prepared. So it goes back to preparation. If something unusual happens, we can defend ourselves. We then need to have a look at inaction when we speak about fear. That's when we see viable trades, but we're unwilling to follow them. So we see a viable trade and we're unwilling to pull the trigger. We're allowing those losing trades to run much further against us. People are always trying to avoid making difficult decisions by widening those stop losses. But these headings are really dangerous and they can result in deviation. And these are just observations which have helped us throughout the years. These are ways of understanding why you should work like a market maker and not like a retail trader. Does that make sense, guys? You want to work like a much larger entity and not like a retail trader who takes far too much risk. So this next heading, which we'll need to look at, is that of greed. So here's a good question. What do you guys think of greed? Do you think it's good? Do you think it's bad? In the broadest possible sense, what do you think of that word greed? What do we think? Michelle, Francois, you think it's bad? Michelle, dangerous. Graham, dangerous. What else have we got? Both good and bad. Okay. It's interesting, says Manish. Both good and bad, says Judy as well. Poisonous, says Gary. Okay, I guess maybe how we would define greed is important. We would say that greed, it's not you just wanting to make some money. Greed is you having this unhealthy desire, okay? That you want more and more and more, and nothing would satisfy you, okay? That could result in you taking far too much risk and behaving too dangerously. We feel that we don't have an issue with people trying to generate more and trying to support themselves. And ambition, yeah, absolutely. Ambition, Bonnie, it is good. But we don't like the idea where people will solely focus on bringing in more at all costs. And it's because of the saying, somebody else has typed it in, Baruch, you've typed it in already, that pigs get slaughtered. And the idea of that pig is the new trader, okay? The pig is the participant who comes to the market and who instantly expects to have massive rewards. And what they do is essentially they feed the more cautious traders. So they feed us and they give us profits by operating with that huge level of risk. So they come out, they expect everything to be easy, they trade too large, and then they wonder why it all goes wrong. And when you look at different ways of trading out there, okay, when you look at this type of thing, there are some operators who will try to make you trade, let's just get this on screen, they'll try to make you trade with €1 or $1 per point or per tick. Do you think $1 per tick is a large or a small trade size? What do we think, guys? Do you think that's a large or a small trade size? What do we think? What do we think? Do we think that it's a large trade size or a small trade size? Well, let's rephrase the question. Let's imagine euro dollar, it's moving at 150 pips per day. And if you're trading at $1 per point, that's going to cost you $150 if you get that one trade wrong. Okay, for one wrong trade, it's going to cost you $150. And if you were trading at 1% risk, you would need to have a $15,000 account just to trade a currency like that with a modest level of risk. What do we think of it now, guys? $1 per pip on a market that's moving with an average amount of volatility. It sounds small, but you can see it's not. If you were trading off a longer term movement, that's a huge amount of exposure. Most people who start into trading, they don't start out with 15,000 to commit to begin with. Most would commit a couple of thousand to see if it's for them, if you like. That's a nice way of understanding if it's for you. So you would want to be able to trade somewhere where you don't have to take that much risk, where you could trade at maybe 10 cents per pip or something like that. That's more appropriate as a position size to ride out those natural movements. And those greedy people out there, they will want the huge positions straight away, but leave them to it. We also would prefer if your focus was intellectual, because if you can develop a passion for your subject, you tend to do much better. If you could set yourself some targets, if you're completing the foundation trading program, by what date are you going to know every aspect of it inside out? By what date are you going to have a full trading strategy that you know inside out? All of these headings, they can really help you. Discretionary trading does far from that. So we need a strategy, we need our pending orders. And we also know that typically when traders are trading above 5% risk, they can see a complete obliteration of their account. We like less than 5%, less than 1%. We like to keep our overall risk levels down below that 5% area. So maybe we've been pretty negative up until now. But why do we take this negative slant when we're delivering education? I think we believe we've got a bit of a moral duty to do so, if you like. And what we mean by that is at the start of the foundation trading program, we try to make our services as accessible as possible. The reason being, it's good for business. Okay? So we try to make everything accessible. And some people come to us and they really they're expecting crazy things. They expect that by the 10th webinar that they can give in their notice, they can tell their boss that they're quitting because they're going to be making 10 or 20,000 per month. Okay? If things were that easy, the world would just be a much different place. Things are never that easy. Okay, it's just not that straightforward. You guys have got to have realistic expectations, and given the fact that you're on the final webinar of this sequence, you more than likely do have the right type of expectations. So what we are saying is we are quite cautious in our approach, we're quite selective in what we say, because it simply puts off the wrong type of people. It tells the wrong type of people that we're not the company for them, that they should go to somebody else who's promising something crazy. They should go to, a magic bean solution provider. But the truth is that trading can and is very lucrative. It's very well rewarding from a financial perspective if you know what you are doing. And there is a golden rule, and that golden rule is that you should never allow any single event to generate an emergency response of body or mind. Okay, so we never ever allow that to occur. We keep in mind the total worst case scenario. We take steps so that we have our strategy. We take steps so that we can test our strategy. We take steps so that we can journal absolutely everything. So that we can know exactly what we are doing. And we can then speak about trade frequency and psychology. What we believe is important is a smaller amount of higher quality trades. How many trades per day do you think, or maybe what's the best way to phrase this? How many trades per day do you think we would feel are appropriate, guys, per day? How many do you think we would feel would be appropriate per day, roughly? Do you think it's 1? Do you think it's 5? Do you think it's 10? Do you think it's 50? Do you think it's 100? What do you feel we believe is an appropriate number for a new trader per day? Okay, believe it or not, for our most advanced students, the average amount of executed trades per day is coming in between 1 and 2. On average, it would come in at probably 1.5 trades per day, and that's probably dramatically lower than what you were used to. And the reason why is because we don't care about the amount of trades that you take. All that we care about is that you do well. So that's where our interests and your interests are fully aligned. And we're not aware of anyone else out there who can truly say that. Because if you do well, it's really, really good for us. Okay? So we believe that 1 to 1.5 trades per day is the right amount, and absolutely, Fike, it comes because it's quality rather than quantity. And most new traders, they tend to want to spend a minimal amount trading, maybe 30 minutes or so per day. Okay? So if you want to spend, let's say, 30 minutes per day, and if you were wanting to trade 10 positions, that would mean that you were spending no more than 3 minutes making a decision. And if you were willing to risk $100 on that event, on each one of those trades, if it was 3 minutes for 10 trades in return for $100 risk, it doesn't sound like a great idea, does it? But what if you were to spend a much larger amount of time trying to get to the bottom of it? Wouldn't you feel that you had put more work in, so the outcome was therefore likely to be better? And we also attach our identity to our actions. So it's important that we do that we understand high quality actions. We prefer longer term movements because it sees us in more favorable trending positions. Shorter time periods, that will mean you're accepting more risk. Okay? People fail to use stop losses. Let's go through a scenario about how dangerous not using a stop loss can be. We've worked with many different types of individuals over the years. And lots of people, they come to us and they might have been elsewhere. But what we find works is we don't really mention particular competitors. We don't speak about them or anything else because basically it's not who we are. We prefer to just do our own good job, and that should speak for itself. We don't try to tarnish other brands. We believe that their own competencies will do that for them. But this one particular client of ours, they had gone through an educational event, a so-called educational event with a competitor, and they'd learnt a method where they were trading short-term trades with large position sizes with no stop losses. What do you think of that scenario? A short-term position with a large position size with no stop loss. So it was a big position over a short time period and there was no protective stop loss in place. The idea was that huge returns could potentially be generated. But this client of ours, they had just received their redundancy for a particular role and they put it in to a trading account in order to try and generate a full-on income from trading. So this gentleman, he was trading on a particular market. He was trading at home in front of his machine and there was a knock to the door. Nothing unusual about that. But the knock was to give him some news that his daughter had been in a car accident. So what do you think that gentleman did in that scenario? What do you think he did? What he did was the same as what every single one of us would do. Okay, he just went out the door. Of course he left his screen. He didn't return to his computer. Okay, he left his positions running. Okay, and that could happen to any one of us. For those of us who that scenario mightn't ring true for, okay, there are a couple of different options you could go for. Okay, imagine you put on a trade and imagine you try to exit out of that position and at that exact instant, maybe your electricity goes, maybe your broadband goes, or maybe your machine goes into an automatic restart, or any one of those situations and you can't get out of that position in time. What's going to happen is that your whole account is going to be in jeopardy. It's going to be exposed to risk. And at some point during your career, somebody will knock on your door, or somebody will phone you, or some electricity will go. And if you're silly enough to have traded in a reckless manner, you will eventually lose it all. Imagine you'd built your entire trading portfolio, you'd built it up, and you had lost it because of some craziness outside of your control. That's not the way you want to operate. So if you take anything else from this, you should use a stop loss. You should protect yourself. And we must also look at these longer time frames. It allows us to be much more objective. When we talk about a longer time period, we say maybe 7, 10, 15-day trade duration. That's really what we are essentially focusing in upon. We find that shorter time periods, they are unnecessary and they can be too dangerous. We also find that nobody should ever attribute their successes to themselves. Okay? People look at trading, they look at practice accounts, they look at live accounts. In terms of a practice account, will you ever learn to trade on such an account? I can see that for some reason my PowerPoint decided at this very opportune time to shut itself down. If you wouldn't mind just bearing with me for a minute. Let me see if I can get this back up for us. Okay, let me just see what I can do here. Apologies, guys, for this. Okay, let me dig out exactly where we were. Wouldn't it typically be the last class where we encounter a little bit of an issue with Microsoft? That certainly should not be the case. Okay, let me have a look. We were speaking about attribution. Okay, I think we're back. I think we're okay. Let me just double check everything from your end. And there we go. Is there a better time for something to shut down when I'm speaking about it in the middle of something, and without any warning, down it shuts and away we go? You'd imagine that I had planned it. I nearly wish that I had at this stage. But there we go. Absolutely, Michael. Your unexpected occurrences. It just goes to show. Imagine if that was a trade. Imagine if that was a trade. So, there we go. Okay, we're back. No problem. So, if you attribute your success to yourself, it can be a huge error. Okay? When you're especially trading, when you're especially using a practice trading account, people feel that that is the best way to learn. And it's not bad to get a way to understand the markets. Okay, it's not bad to get a feeling as to how the markets operate, but it is very, very different than actually trading. It's no different, in my opinion, to using your PlayStation or to using your Xbox. So maybe we won't talk about Microsoft products after what's happening, but imagine it was using your PlayStation. Okay, if you're on your PlayStation and you're on a car racing game, it's a lot different than you driving your car. If you're on a PlayStation and you're playing a golf game, playing Tiger Woods golf, it's a lot different than if you're actually on the golf course. You tend to be more mindful when the event is real. Okay? So it's totally different from how you would behave in real life. When you're having successes on a live account or a demo account, just view it as how your strategy is performing. You've got to view it in that way. Because what happens is when winning streaks occur, you've got what we have, inflated head syndrome. And what that means is that you will have difficulty walking through your doorway. Because your head will have expanded so much because of those successful trades. And what you will do with your massively large head is you will trade larger positions to go along with your big head. And then what happens is the market will figure out that there is a trader with a massive head and a massive position, and it will take your money. It will also stick a very large pin directly in your forehead. You will quickly become deflated, as will your trading account, because you took too much risk. And that's something which we do not do because we like our money. So we don't fall victim to that type of scenario. We also self-criticize in terms of when we get it wrong. We must evaluate everything we do. Okay? And we have to say to ourselves, well, what is the most relevant information? Is it the oldest information? Is it the newest information? But we don't lose sight of any particular time period. It's important to realize this. If our primary chart is a one-day chart, well, we will also look at 1 week or 1 month charts. Because by doing that, we will have a much better picture for what exactly is going to occur. And then we need to look at an area of major kill switches. And what this means is we figure out when we are going to simply stop trading. If something really unusual has occurred, well then what we aim to do is we aim to get out of the market. We cease trading. If we're in positions, we tighten up stop losses. We get out. We evaluate what just happened. We use the event as motivation. Okay? We use it as motivation for ourselves. And looking at this further, we need to ask, how are we going to be disciplined? The only firm way to be disciplined is through confidence. And the only way to gain confidence is to know exactly all of the ins and outs of your trading strategy, to fundamentally know what you are doing at all times. That's what we really mean, and that's how you generate more confidence. So in our opinion, it's the only way it's the only method by which you can become confident, by having that education and then by having the experience. And when it comes to the trading event, it's important to point out that we do not focus on the money. We focus on the pips instead. We focus also that we are improving. And we're improving every single day. And the major aim of every single trader should be to increase that knowledge, to focus on the processes involved, to focus on your form. Because once you've got a strategy, you're then focusing upon your technique. You're wondering how to make that strategy perform even better. Because if you were bringing in a particular number of pips, when you're more comfortable with the financial markets, what you might wish to do is to attach a larger value to each one of those pips. Okay? When you're really comfortable, you can slowly increase your trade size. And that then means that you could generate a greater return in those ideal scenarios. What you're trying to do is you're trying to develop and treat your trading just like a business. And we also never like the idea of counting a profit until the event has occurred. And by that, we mean until the trade has actually been closed and the gain has been realized. Okay? When we spoke about that 9th lesson, or when we looked even at the positions that we might consider, it's important to understand when any time you are valuing your account or any time you're taking risk, okay, the valuation of your account is crucially important. And how you value your account will be dictated by the strategy which you use. And many of the strategies which we use, we go for a net valuation, where we ask ourselves, how bad could it be if every open position which we had ended up against us? And it's that valuation which we take a percentage of. And it's a really conservative approach. And we never count a profit until it's realized. Imagine if you were up $200 on a trade, and you might go around thinking that you've made $200. You haven't. The trade isn't closed out. You haven't made a profit until the trade is closed. Does that make sense to everyone? It hasn't really happened until the trade no longer exists. So you've got to wait for that to occur until you get out. And there's people out there, when they're trading, they'll say that, yeah, I'm making a lot of money, I'm up, I'm profitable. Or maybe even more popularly, there are people who invest in shares. And they feel like they are very, very wealthy at particular time periods. Maybe even like right now, we're still in a bull market, besides the most recent market action. So markets have been trending upwards for the past few years. And those people would feel that they are very, very wealthy. But when it turns, which it will, which it always does, they will lose everything because they don't know how to hedge. They don't know how to diversify. They don't know how to get into precious metals. They just knew how to buy and keep their fingers crossed. So what we must do is we must track what's happening and protect our profits by adjusting stop losses and by moving them in the right direction. Going beyond this area, we need to speak about distractions. Okay, so we need to create these positive habits. A lot of people, they suffer from distractions, and when it comes to trading, you need to get into a routine almost. You need to have a plan. You need to have a regime because it's not all going to be drama and excitement. Being a professional does not mean that. So we try to trade at approximately the same time each day. We try to ensure that our communications with the external world is kept to a minimum. If that means getting up earlier or going to bed a little later, then so be it. But it's great from your own perspective. And what we mean here is that it is something exclusively for you. So you would tend to view it as a business. And if you were starting any sort of business, you would need to learn everything about that area. You would create a business plan, just like a trading strategy. You would work out the risks, like a risk management strategy. You would create forecasts. You would dedicate time to your new venture. And you would invest amounts of funds that you would be comfortable with. But you've got to view your trading like a business because you're here for a reason. Many of you are here because you wish to generate a secondary income. Many of you are here out of the curiosity or out of the independence that financial trading can give. So you must go back to that original mindset, because with that original mindset, if you take the right steps and if you dedicate the right time and effort, you can achieve your objectives. It's just about all of the small parts in between which is important. Next, we speak about journaling, and people might say that journaling is boring. But you know what? We don't care, because when we speak about journaling, it's crucially important that we manage ourselves. In every professional trading environment, you have somebody who is managing you, who is making sure that you stick to the plan. But as a private trader, you don't have that luxury. So what you must do is you must manage yourself. You must protect yourself. And journaling will allow you to do that. We're not talking about a massive essay every day. Let's have a look at a basic example of what we are talking about. Let me just get this up on the screen. I'm just flicking forward a little bit, but you can see this Excel-based example. Okay, let me get out my pen and we'll run through the columns. So this very first column, okay, on one of the strategies, or on all the strategies that we use a lot more automated system, a much better system tied into our trade sizer. But this is quite useful. If you have a journal, you can have a trade number in A. You've got an order number next. Your trade number could be your identifier. The order number could be your broker's identifier. You've got the date which you open, the time which you open, the object that you are trading, the direction, whether you're long or short, the size of the trade, the entry area, the stop area, the limit area. If you exited, you're asking if the exit coincided with either the stop or the limit. You're asking, was there any slippage? You're looking for a gain in pips. You're looking for a gain in monetary terms. Okay? So you're journaling everything out. You're keeping a record of every single thing got to do with your position. Okay? Then we say, well, what was the reason for the entry? Maybe the Swiss National Bank. Maybe it was discretionary. Maybe it was technical. The reason for the exit, a top-end failure. And then what you can have to the right-hand side of that could be your own notes. Okay? And what that will mean is, why did you take that trade in the first place? And then you might have another field which asks how you felt when you entered and when you exited. and studying that at the weekend, studying your largest loss, your average gain, your stops, your limits, your percentage accuracies, and everything else. It's brilliant because the trader next to you will not do it. There will be somebody out there who will be entering into the market with too large a position, who took too little time to analyze this, who didn't work with the right people, and that's who you are targeting. Okay, that's who you are targeting. We believe that everything should be journaled. It's a way of protecting yourself, and yes, it might sound a little tedious, but you record everything and you review absolutely everything. Why? Because you're becoming a professional. You do not leave things to chance. How could you learn from the past if you didn't document it? So we see that how we enter, that isn't the full question. We get an entry signal. It tells us to pay more attention. Our rules will tell us whether or not to actually take the trade. Our risk management tells us how much to risk on the trade, whether it's from an individual sense or on an overall sense. And it also tells us how to manage the gain. These are just pieces of a full trading strategy. Okay? So all of these headings are massively important. What I can do now that we have a little bit of time on our side is, if you wish, I can go through the process of a full trade. So would anybody like to see the full trade? Exactly what we do in order to justify an entry, the steps that we take, the processes involved. If there is enough demand for it, by all means I will do it. Okay, a lot of positive answers coming in. No problem. We'll take the time to do it. That's absolutely fine. Okay, so let's have a look. This is our ultimate trading indicator in action. So we will now go through the full process. There are a couple of steps involved. Hopefully it will make a lot of sense. Hopefully it'll make at least a little bit of sense, but let's try to keep up. There are some hypotheticals involved in a way. We have to turn back the clock a little bit in order to understand the reasons behind the trade, and then hopefully we'll be able to go from there. So the very first step, which we begin with, is we choose our market. What I've done here is I have chosen the Euro-Canadian dollar, the Euro versus the Canadian dollar. And if we look at this downtrend, we can say that it's not a current market, it's a recent market, because I've had to go back a little bit in time to the beginning of the beginning of November of last year. So when we look at this market, to choose where to enter, that's a very subjective question. Okay, to choose where to enter is a very subjective question. You'll have some idea, I might have a different idea. If I was to put the question out to the floor, I'm sure that every single person has got a different opinion as to what might constitute a good entry point. So what we do is we don't rely upon our opinion. We have our indicator. So we apply our indicator to the chart. That is step number 2. And this is what our indicator looks like. What I've done is I've just applied it to the long side of the market so that this chart doesn't look too cluttered. But when we apply our indicator, we have a couple of levels of interest. The levels of interest are initially the blue line, and then further on we've got a black line. It's hidden behind that little bit of writing that's on the screen. That writing is also part of our indicator, but the initial level of interest, that's the third step. We take a note of the levels of interest to us. And what this indicator is telling us at this point of time is that it's giving us a signal to place a long order at that price of 1.4384. So that's our signal. Whether or not we actually enter is determined upon our portfolio, how it's performing. So there are a number of different, gates which you have to go through to ask yourself whether or not you actually want to place the trade. But we're going to take it that hypothetically we are going to place the order. Imagine our portfolio is telling us that yes, we're allowed to take a little bit more risk. Our portfolio is performing as expected. Well, imagine that. So the next step, we go to is we open up our trade sizer. And when we open up our trade sizer, we need to fill in two specific areas. One is the volatility level. When that volatility level is filled in, it's going to give us our trade size. And the other area which we're going to fill in is this LEWT. The EWT, that's just one of our strategies. It refers to that blue line. So that, in this instance, is the other side where we're going to fill in a value. That value is taken from where the blue line is on the chart. When we fill it in, it's automatically going to provide us with our stop loss. Our stop loss level, is automatically generated so that we don't risk any more than 1% of our total trading capital. So we put in all of the information as per our indicator. Our volatility level is in. Perfect. 0.1545. That's the amount of pips of movement that this market is moving in every day within the last 10, 14, 15, 16 days, whatever the strategy is telling us to do. By inputting that volatility, it means that we now have our trade size. We also put in where that blue line is, the level where the blue line is, which is 1.4384. We just took that from where the blue line is on the chart. So now we have all of the relevant pieces of information. So, step number 6 is to simply place that order. You open up the platform, you open up a pending order box, and the first thing we do is we place our trade size. So the volume equals 0.48. We've taken that from our trade sizer. That's the size of the trade that our trade sizer told us to take. The next thing we do is we want to put in where we want to place the order at. It's not at the current price, it's at that blue line area. So we put it in at 1.4384. Perfect. 2 pieces of the puzzle are filled in. The third point is the stop loss. We put in our stop loss at 1.4075. And that's to ensure that we don't risk any more than 1%. That is everything completed. All is good. So all we do now is we simply place that order. Once we have all of the relevant information in, we just press that place button, and then the order is activated on the screen. Are we in the market? Absolutely not. Absolutely not. All we have is we have placed an order so that if the market moves to our ideal entry point, then we will be in. So when we place the order, we can see our levels of interest. We can see our entry area. We can actually see it there on the chart. Our entry level is that green dashed line. We can also see the corresponding stop loss area. The corresponding stop loss area is that red dashed line. We can see how both the green dashed line, how that corresponds exactly with where our indicator is telling us to place this order. It's corresponding exactly with our blue line. So over the coming days, the market moves in our favor. Our entry has been activated. The market moved up. It hit our entry point. Our stop loss remains intact. We still have not hit our stop loss. All is good. Our stop loss point remains absolutely intact. The market has moved in our favor. Our order is hit. So we have a gain in this particular market. Have we realized this gain? No, we haven't. It's an unrealized gain. But now the final step is to manage this movement technically. We manage this movement technically. So what we can see, what I've actually done is in December, the last time I was presenting this foundation trading program, this was the slide that I've used. You'll see the date. You'll see the date on that bottom right hand corner is back from early December. And you can see the gain at which we were up at that point in time. Now, luckily enough, we've obviously moved on in time, so we can now see how that trade actually performed. So as the year progressed, as the year came to a close even, as the new year came, it continued on in our favor. And what I did when I was preparing for this class last Friday, which was the 21st or 22nd of January, whatever it was, when I was preparing for this class, I just took a snapshot as to where this market was at that point in time. We had yet to realize the gain, but what we had done in the meantime is we had managed the trade technically. We had moved our stop loss up as the market rose in our favor. And as the market rose in our favor, and as we moved the stop loss up, we can hopefully all see where the stop loss level was. That dashed red line. And that dashed red line, what it corresponds to is the opposite red line right here. So you'll see at this exact area where I'm going to place an X, that's the exact value as to where our stop loss was. That is how we manage the trade from a technical sense. And believe it or not, about an hour, maybe 2 hours after I took this screen grab last Friday, our stop loss was hit. And our gain then became a realized gain. It became a profit. It became a profit, and from memory, I think I have it written down somewhere, the gain made was €3,215.59. So just under what is on the screen there. Right, just under, because the market came back down a little bit. Our signal told us that the trend had come to an end, that it's time to exit the market. We had our stop loss technically managed, so we would exit in that profitable sense. And that's exactly how we do it. You don't have to be looking at your screen in order to realize your profit. Once you are using some proven strategy to technically trade the chart, using these pending orders, then it makes life an awful lot easier for us. That's what our ultimate indicator is. That's what our proprietary trading software is. They're not moving averages. You can see that the price never crosses through them. The price never crosses through our indicator. It pushes our indicator in front of it. That's exactly what they do. So hopefully that'll give you, a thorough explanation of the steps involved, the steps that we would take on a daily basis every single time that we want to place a trade. It's both as easy and as complicated as that. So I hope you've got some use from that. That's exactly what we look to do every single time. Okay, so let's move on. I do have an honest question, however, in the meantime. And that honest question does actually relate to becoming a trader. I've come across this only in the past, I think it was about 5-6 weeks ago, from a website I tend to frequent. And the honest question that I have is, who wants to become a trader? The reason why I'm asking this, I'm not trying to be in any way to put words in anybody's mouth, but I felt that this was very important, to show people. This is a genuine ad for a trader with this company called 3 Red Trading, and I found it on a website called zerohedge.com. And if you see what it takes to become a trader these days, and then if you compare that to the retail traders who are out there, you will now maybe no longer wonder why those retail traders are not winning. You'll maybe no longer wonder why those market makers are the ones who are winning. The points, that stand out for me is you need to have a degree in mathematics. You need to have 2 years and related experience in diagnosing and optimizing predictive factors of short-term returns. But the more important points are somewhere down here. You're designing low latency trading strategies. It's about the market making industry. It's about, a strategy. It's about using those market makers to move the strategies, or to move the markets, So it just it goes so far beyond the retail trader. How can that retail trader ever expect to survive? It's still reliant upon that strategy element, aren't they? They're still reliant upon those market makers and trading exactly like them. So I just thought I guess I'm going to say it's a little bit humorous, but it is important to understand the type of qualifications, the type of person that it does take to become that successful trader in the industry these days. What we are doing, our methods, I guess what we're doing is we're simply following on their coattails. We're trying to replicate what the market maker is doing, and we're steering as far as we can from the retail trader. So, all of these headings, they're crucially important. The correct application of risk management, that will protect you. The technical analysis will find you entries and exits, and the psychology will reinforce everything throughout. You've got to focus upon upskilling, upon becoming more experienced, and on being determined in order to achieve your objectives. Because the truth is that financial trading is extremely profitable for those who put in the right work. It is dedication, it is perseverance, and it's the one question as to how much anyone wants to achieve their goals. That's all that you've got to ask yourselves. We've really enjoyed delivering all of this content throughout your foundation trading program. We really have. And what that means is that you should know which direction you wish to proceed in. We've mentioned time and time again in terms of our Ultimate Traders program, in terms of our lifetime membership to Show Academy, and unashamedly so, because it is something that we are exceptionally proud of. What we're talking...
Now, I'm not saying I don't like kids. I like kids. I have fun hanging out with my friends' kids and joking around with them, whatever. They're great. But I do feel like when I talk to my friends that recently had kids, it does seem like they had to give up everything for the kid. And that's very scary. You want to have a depressing conversation? Talk to a couple that just had a kid. Ask them about the last night they went out for themselves. They will describe the most boring, typical, mundane evening out.